My name's Emile. I've built a national franchise network, and one of the biggest mistakes I see from franchise buyers is they look at revenue, but they don't understand profit. In this video, I'm going to break down franchise numbers in the simplest way possible. No jargon, no degree required. Because too many people walk into a franchise, they see big revenue numbers, and then realize later there's barely anything left in their pocket. I'm going to walk you through a real simple breakdown using $1, real examples, and a whiteboard, so by the end, you actually understand how a franchise or business makes money. G'day team, welcome back to Courtside Conversations. I've got a Numbers for Dummies series, no pun intended, I was a dummy when it comes to numbers. And we're going to be talking about numbers today, specifically related to a franchise. Now picture this for a second. You're about to come into a franchise and you ask the franchisor, hey, can you send me a sample P&L of how a franchisee is performing? P&L stands for profit and loss. And they say, no worries, here you go. And you look at the P&L, $500,000 in top line revenue. Wow, my God, $500,000, I'm going to be making $500,000. And then you go through the line items in the P&L, and at the bottom, there's $20,000 left of profit. Wait, hold on, what's happened here? He's turned over $500,000 in revenue, and he's got only $20,000 in profit left in the bank, and he has to pay taxes on that profit. My gosh, when you're confused, you're perplexed, you don't know what's happened. Today, I'm going to explain to you exactly how to understand the numbers when it comes to a franchise, because the most important term that you will hear when it comes to franchise is understanding how the unit economics work of the business. I'll say that one more time. In franchising, you've got to understand the unit economics of the business, aka how the heck does the business make money? How does a business model make money? How it makes money will directly influence your return on investment. So what we're going to do in the whiteboard is I'm going to give you an example using $1, because if you understand how it works with $1, you understand how it works on bigger numbers. We're going to break down a P&L when it comes to $1. And then I've got a challenge for you. You're going to pause the video once you understand how $1 works, and you're going to solve this case study, which is if I've got 300 kids paying $200 per child, I'm running 19 classes per week, I've got 2 coaches at $30 an hour, court hire, $80 per hour. How much profit have I made? That's going to be the challenge for the video. Let's get cracking. Okay, righto. So using $1 as an example, let's say you've turned over your first dollar in revenue. Congratulations. The start of many more dollars to come into your business. You've made $1. This is called revenue. I'll just put brackets revenue. Everybody knows how this works. This is revenue, sales, top line, whatever you want to call it. What's the first thing that gets sliced out of it? It's the royalty fee. Here we have a 10% royalty fee on revenue. So what's 10% of $1? We put here, quick math, 6, 7. 10% on $1 is 10 cents. So royalty is the first thing that gets chopped off. Royalty, 10 cents. How much do we have left over? If 10 cents has been chopped from the dollar, we've got 90 cents left, right? So automatically the royalty fee, 10% has been gone off, whatever the royalty fee is in the franchise. Ours is 10%, 10 cents. We now have 90 cents left. And by the way, when it comes to revenue, you should understand what your different categories of revenue are, because revenue can come from different places. For us, with our franchise, we've got over here, we've got term classes, holiday camps, school programs, basketball birthday parties. We've got different types of revenue categories, so make sure you understand where the dollar is coming from. But for the sake of simplicity, we've made $1, we've paid the royalty fee, we now have 90 cents left. Let's move over to the next element. Righto, number 2 is COGS. 90 cents left over. COGS stands for cost of goods and services. So I'm going to put here, we have COGS. Now, COGS in any business, I might move actually here. COGS are simply the direct expenses that you need to pay to deliver the service. You must pay these to deliver your service. They're mandatory and every single service needs them. So for us, in the children's basketball space, what are the COGS that we need to pay for? First one is court hire, right? You can't run a basketball class if you don't have court hire. The next one is wages, coaches' wages. You need coaches to run the class. So some of the COGS that we have, remember, cost of goods and services sold, court hire, coach wages. The way you think about it right now is just think, what are the direct expenses related to delivering the service? Okay, so we've got COGS. Now, where should COGS be? I recommend your COGS should be less than 40%. You don't want them higher than 40% of what your revenue. If it's higher than 40% in the children's sports industry, that's way too high. It's got to be less than 40%. So let's say it's at 30%. So we got COGS here at 30%. Okay? So now 30% out of our 90 cents is gone. I'm going to pause the video to get my calculator out. Okay, so 30% of 90 cents, we pay 0.20. So this equals, let me go here, 0.27. So it's costing me 27 cents to pay for my coaches and court wires. Now we deduct 0.90 from 0.27. Let's see what we're left with. We are left with the final figure, 0.63. So what does this mean? We had to pay our royalty fee. We were left with 90 cents. We then had to pay our COGS, our direct expenses with delivering our service, which was court hire and coaches' wages and whatever else you might have that's directly related. That costed us 27 cents, which now leaves us with 0.63 cents. We're now going to move to the next element, which is expenses. Now, if COGS are the direct expenses related to delivering the service, so you need them to deliver your service, effectively expenses are indirect expenses in running the business. So these are all the day-to-day expenses that you might need to keep your business up and running. For example, marketing. Marketing's not essential. You might not need it. Your wage, you might want to pay yourself a wage. You don't have to, but you can. Rent. Pretty much, team, your expenses are everything that you need to pay for to keep your business afloat. You don't need them to deliver your service, but they're needed to keep the business afloat. That could be marketing, wages, rent, Facebook ads, whatever it might be. In our industry, we want to keep this at less than 30%. So let's just say we've kept it at 30%. Now what we're going to do is we're going to calculate 30% on 0.63, which is what we have left over. 1 second. Okay, so 30% of 0.63 equals, we've got it here, 0.18. Let's just round it up. So the expenses are costing us 19 cents. So we're going to go 0.63 minus the 19 cents. And that gives us 44 cents remaining. So we've got royalty fee, 90 cents. We've got COGS. We want to keep those less than 30%. That's 27 cents. That leaves us with 0.63 left. And then we have our expenses. We said were 30%, your marketing, your rent, etc. That gives us 19 cents. We now have, from our original dollar, 0.44 remaining. Hey, just quickly, if you want to see if there's an available territory to own a Little Boomers basketball franchise in, click the link below to our map and see if there's a location near you. So we can now say that we have 44 cents of net profit remaining. This is what's left in the bank account. This is probably the most important metric that all businesses should track. It's not revenue, it's how much net profit, I'll put here, NP. It's how much net profit we have. And the only way to calculate net profit is to have your revenue, take out COGS, which is directly related, take out your expenses, and this is how much profit you're left. Now, in a children's sports industry, we want to aim for a minimum of 30% net profit. NP, 30%. If you're running a profitable franchise, you're very conscious of your COGS, your court hire and your coaches' wages, you're running a lean business with minimal expenses, in our industry, you should be able to achieve a net profit margin of 30%. And just remember, this 44 cents that you have profit left, you've got to pay taxes on that here in Australia. You've got to pay Uncle Sam. So if you're running a company, you're probably going to pay 25% tax on your net profit. So 0.44 times 0.25 Let's see how much tax we're paying on 44 cents. Give me a second. 11 cents, 0.1. So now we're left with, after taxes, we go 0.44 of profit minus the 11 cents we need to pay on taxes. 0.33 of profit. So effectively what I'm saying here, team, hopefully I've still got you and I haven't lost you. If you've got 44 cents of net profit, you've got to pay 25% tax, assuming you've got a company. That means you've got to pay 11 cents on that. Minus the 11 cents, you're left with 33 cents. So what we can say now from this is from that dollar of revenue, after we deducted our royalty fee, our COGS, our expenses, we have 33 cents of profit. Now, case study. What I want you to do, I want you to pause this video, and the question that I want you to answer is, if you've got 300 kids in the program paying you $200 per child, you're running 19 classes a week. Each class, so for each class, you need 2 coaches at $30 an hour, and the court hire is $80 per hour. So every hour you got to pay $80. It's also an 8-week program. I'll put here 8 weeks. How much profit have you made before taxes is the question that you're solving for. 300 kids, $200 an hour, 19 classes a week. It's an 8-week term, 8 weeks in a term. 2 coaches at $30 an hour, court hire, $80 per hour. Pause and let's see if you can figure out what the net profit is before taxes. Okay, how'd you go, guys? Whatever your figure is, let's see if it's right. I'm going to help you work this out. So 300 kids at $200 per child. That's quite simple. We're going to go 300 times 200. Let's see what on the calculator it says. 300 times 200. Okay, $60,000 in revenue. Let's break it down. Okay, we've made $60,000 in revenue. Now, believe me, the novice business owner would think, yeah, I've made $60,000. Let's celebrate. Let's go out to the casino, put it all on green. But you're not a novice business owner because you've just learned that we need to pay for COGS. Now we're going to figure out what the COGS are. All right. Let's break this down. Here we go. COGS. Let's do court hire. Okay, so to calculate court hire for the 8 weeks, we're going to go 19 classes per week. We're going to multiply that by 80, because if it's $80 per hour and there's 19 classes times 80. And then we're going to multiply it by 8 weeks, because if you're booking out a stadium, you're booking it out for 8 weeks. So it's 19 multiplied by the hourly rate, 80 multiplied by the number of weeks, which is 8. Be right back. Okay, so your court hire fees is 12160. So let's put it here. 12160. Remember, these are COGS, but we're not finished yet. We need to do wages now. How do we calculate the wages? 2 coaches at $30 an hour. We're going to do 2 times 30, which is 60. And then we multiply that by the number of classes per week, because I'm sure you've got 2 coaches at every class. And then you multiply that by an 8-week term. Very simple. 60 times number of classes per week, 19, times 8. Be right back. And that gives us 9,120. So what have I done here? I've calculated my revenue at 60K. My COGS, my direct expenses to deliver my service. Court hire is about 12 grand. Wages is about 9,000. That gives me a total COGS of, okay team, so total COGS now, if we plus these 2 up, 10,380. Okay, now, I've calculated my revenue, but question, which have I missed? I've missed an important figure. Correct, the royalty fee. So if I go here, royalty, I'm running out of space. Who can tell me if I've made $60,000 on revenue, what's 10% of 60,000? Yes, $6,000. Okay, Remember, you've got to pay the royalty fee. It's the lifetime of the franchise agreement. So $60,000 isn't 60. I have to deduct the royalty fee, which is $6,000. I've got my COGS at 10,380. Now, as you can see, there's no expenses. I haven't put any expenses, no marketing fee, no direct wages, nothing. I wanted to make it a simple case study. So now we're going to calculate what our net profit is. And to do that, we're going to go $60,000 in revenue minus $6,000 royalty that we give to head office minus $10,380 for the COGS, which gives us a final figure of a net profit, let's write it here, of 43620. So we can now say that this term with 300 kids at $200 per child, we made $60,000 in revenue. From that $60,000, we paid a royalty fee of $6,000. At 2 coaches at $30 per hour, with court hire at $80 per hour, our COGS, cost of goods and services. Court hire was $12K, wages was $9, the total was $10,380. We made a net profit before taxes, because you got to pay taxes on your profit, of $43,620. If you got that answer right, put it in the comment below. If you got it wrong, tell me where you went wrong, maybe what you miscalculated. And that's it, team. These are the financial numbers that you need to understand before you come into a franchise. So when someone says, what's the unit economics of the business? They're saying, how does the business make money? And this is how the business makes money. The question is, how can you scale that from 300 kids to 400 kids to 500 kids? And some of our franchises are killing it with 500 kids. Team, I hope you enjoy this video. Thank you for your time, and I'll see you in the next video. God bless.